Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday and weekly market recap. Hopefully you guys had a good week and are starting off a very good weekend too. Now, filming this one on a Saturday was indisposed and busy on the Thursday and Friday nights, so thank you very much for your understanding and your patience, but better late than never. Next week, we return to the normal schedule of video uploads every single day. So in terms of the Friday action, guys, of course we know that the bears absolutely took control of the markets off of the back of a less than favorable Michigan consumer sentiment report. Now, we know that front and center recently have been these soft data points, as the Fed likes to call them, the consumer confidence and the consumer sentiment reports, and any bad notions about the expectations of the future amongst tariffs, amongst the uncertainty around the economy, are really driving down these markets hard, as of course the market just hates uncertainty into the future. However, it's possibly leading us to some very attractive buying opportunities once again, as we had just a few weeks ago. And I was also telling you guys to exercise some caution when looking to buy into these markets, into resistance on the Qs and into resistance on the SPY. We were saying that yes, we did have daily uptrend control, but the weekly bears were always in control on the technicals here, and that they would capitalize with any single piece of negative news that were to come out either from the Trump administration directly, such as tariffs, or any data points that come out would also be a catalyst for the bears to really regain some of that short-term control momentum that they've been benefiting now from in the past month and a half of trading. Now, in terms of the video today, guys, we got a lot of things to talk about. Number one, we're going to be recapping the technical analysis on all our major and minor indexes. Study the rotation, study the market breadth. Where is the money rotating into? Which sectors of the market have been performing better than others, and which are possibly in very attractive buying opportunities right now for long-term portfolios or even for a little bit of swing trade action, and how I'm going about that. Then section number 2 is going to be all about big tech. We're going to analyze all of these big tech names on this list and see which companies are at current attractive buying opportunities for long-term portfolios, and also where I would like to position maybe for some swing trades if the markets continue to decline in big tech, as the rotation out of growth into value continues to persist in these markets, which has left a lot of these stocks in very attractive opportunities in terms of their fundamentals, just looking objectively at the valuations, right? Then lastly, in terms of the video, we'll be taking a quick look at my portfolio for some of the trades made last week. There weren't very many. I was very clear on being extremely patient with these markets and waiting for that April 2nd tariff deadline, which is looming over the course of next week. So I'll be taking a look at my portfolio, explaining some of the trades, and why I'm very happy to be having a ton of buying power leading into arguably the most volatile week for at least probably the next month. So it should be a fairly fun video, guys. Let's jump right into it, shall we? So the SPY last Friday, down about 2% on the Friday. The Qs down 2.63% overall, and a lot of sectors really suffering the burn from that consumer sentiment report. Taking a look at the heat map right now, you can see that most of the damage was done again in technology and also in financials. Some of the rotation, though, was seen in healthcare, into real estate and utilities, and a bit of consumer defensives, which are known to be the value trade overall. When you talk about economic hard times and times of possible recessions, these are sectors that, although they don't go straight up, they tend to have a lesser blow to them, which is why we've been seeing a lot of retail and institutional repositioning into some of these more dividend-paying and more defensive sectors overall. What I do want to bring your attention to, though, is the forward price to earnings on some of these tech companies are becoming very attractive. Microsoft, forward price to earnings, 25. You don't usually see Microsoft that cheap. Amazon as well, forward 25. Don't usually see it that cheap. Meta, 20 on a forward price to earnings basis. Google, a 15, and even NVIDIA at a 19 forward price to earnings. So these tech valuations are definitely coming down to a lot more manageable levels than we saw roughly a month ago. But of course, the damage was done deeply on the Friday session. On the 1 week, you can see that, yes, the bottom half of the market was performing the best out of the bunch. And a lot of the damage that brought down the SPY and QQQ in a big way was kind of consolidated into a few key large players in the market, really Microsoft, NVIDIA, Google, dragging down those indexes overall. When we take a look at the one-day relative, you'll see the only outperformer on the day on the Friday session was utilities. Everything else to the red, led down by communication services, cyclicals, and technology. On the 1 week relative performance, defensives, energy, and real estate were some of the best performers. Special shout out to consumer defensives, they're really taking the cake on this one. On the 1 month, guys, the damage still remains done on those indexes, only energy, utilities, and that's pretty much it to the upside right now. Everything else to the downside. So the damage has largely been done in these markets, but you guys already know that. Now's the time to focus on, is the market currently in a good stage for a buying opportunity, both for swing trades and for long-term investments? That'll be a lot of the focus of today's video. Before we get into the technicals, I just want to do a quick recap on the economic headlines that we got on the Thursday and Friday sessions, because I didn't see you guys, right? So on the Thursday session, we got GDP. GDP was actually decent, coming in at 2.4% versus the 2.3% expected. Not too bad there. Initial jobless claims also not upticking that much. On the Friday session, we got some interesting one, guys. PCE and core PCE coming in slightly above the expectation, which is not too bad overall. We know inflation, as measured by the CPI, the PPI, and now PCE, are staying relatively sticky in the higher 2% range, but are not exploding to the upside. Now, of course, the impact of tariffs, nobody knows, guys. Well, of course, the impact is going to be on the consumer. And of course, you can speculate that there will be a second round of possible upticks in inflation, but that is if the tariffs are kept on and maintained and not removed before they actually make their way into the economy over the next 3 to 6 months. So we will take this 1 month at a time and be data dependent as always. Now, a good point on the Friday session was the personal income was up 0.8% versus 0.4. This is very good. The last time we take a look at CPI, we knew that in terms of personal earnings, personal income is still well above the rate of inflation. So consumers are regaining a little bit of purchasing power, and personal spending has come down over the month of February, possibly people not wanting to spend their money very quickly in terms of the economic outlook that we currently have at hand, right? So that's one catalyst that means that maybe inflation won't be as bad as people are expecting. If people pull back from spending, yes, that will lead to economic slowdown, but that will not lead to a massive uptick in inflation, which is why I'm still not convinced about the stagflation narrative that some of the media outlets have been pushing as of recently. And then we get into the Michigan Consumer Sentiment Index, which came in at a 57, down from the expectation consensus of 57.9, which led everybody to say, well, right now, unfortunately, we are at the worst consumer sentiment that we've had, guys, since 2022. Worse than COVID, worse even than the great financial crisis of 2008. Now, I'll remind you, sometimes you have to take these consumer sentiment reports with a grain of salt, because they're not broad-based. I'll remind you, the total amount of respondents to this survey is between 900 to 1,000 interviews. The US population size is 340 million people. Now, it's up to you to determine whether or not you think that that's an adequate sample size to paint a broad brush across the entire US household base. It's a fairly small sample size, which is why we like to take these reports with a bit of a grain of salt, right? It would be one thing if we had 10, 12, 15 different universities, all with 5,000 respondents each, to give us a better indication, broad-based, of where that consumer sentiment actually lies. But we know the market has been very timid and likes to throw tantrums recently, especially in terms of sentiment, right? We know that this sell-off has largely been entirely sentiment-based. We do not have any real negative hard data right now. That's not to say that it cannot come in the future, but a lot of the worst days in the sell-off events that have been happening over the past month and a half have been either tariff-based off of headlines from the Trump administration directly, or these soft data, confidence and sentiment reports, which are indeed important, but have not yet translated into negative hard data. So we'll continue to balance the data moving forward on a day-by-day basis, of course. And this week should be very volatile because this week we have a lot of things to cover, guys. Now, number one, excuse me, on the Tuesday session, ISM manufacturing report and the JOLTS jobs openings. Going to be a big day. Wednesday, we have the ADP private employment change, which also is the tariff day. Reciprocal tariff day for the markets should be very volatile overall. Moving on to the Thursday session, we come with ISM services PMI. And the Friday, we have another big one, guys, non-farm payrolls. This week is going to be extremely charged with economic data and with headline risk in terms of those tariffs as well. So I completely understand you if you want to take the week off. not trade and just focus maybe on your long-term portfolio buys, establish levels at which you are comfortable to buy into your favorite ETFs or your favorite high-quality companies, because it's going to be a very, very volatile week overall. The expected move on the Qs by the end of the week is roughly about 2.63% up or down. That is one standard deviation. I would not be surprised if it actually blows past this expected move and maybe gives us 4% top to bottom totals, depending on the direction of the markets overall. So that is kind of the outlook for the markets. Before we do the SPY analysis, I'll remind you of the rotation and the breadth and the fear and greed index, right? So fear and greed right now back down to extreme fears at a 22. Market momentum still in extreme fear as we are below a lot of the longer term moving averages. Stock price strength, net new 52-week highs and lows still at the lows of the last year, as not many stocks are hitting brand new all-time highs in this market. Stock price breadth as well remains very challenging at extreme fear reads. I love these breadth indicators because they give me an impression, combined with the VIX, whether it's a good time to be buying into these markets. I'm not saying deploy all the cash, not even close, but can we be nibbling on our favorite companies and DCAing with our paychecks? Absolutely, guys. You know the DCA approach has been proven, time and tested, to be one of the better approaches to be building positions in your favorite companies. Percentage of stocks above their 20-day moving average back down to 34%. I was saying back here in the low 20s, it was a great buying opportunity. Pay attention to this. If we continue to weaken into the week and you see this indicator right here collapse into the lows, it has always been a great buying proposition for the markets when you have a long enough time horizon basis. Percentage of stocks above their 50-day moving average, we never really recovered that much. The top of last week was 33. We are back down to 26%. Has it been a good time to be buying and nibbling into stocks during these market correction periods? Yes, even though we can go lower, it's a great time to start buying, because to be honest with you guys, nobody knows when the bottom is actually going to be. You may think the markets may drop another 10 to 15%. You may think the markets may drop 20% or more, or you may think the bottom is right now. All things, however, lead us to believe that although the markets can drop more, is it a good proposition to not try to time the market with all of our cash? Yes, guys, right? It's incredibly difficult to time the absolute bottoms. The best we can do is buy a little bit and then accelerate our purchases as the market drops into your targeted levels, right? You can use my levels, you can use your own levels. The one thing I do not want to see people do is panic sell everything, go away for a year, just be done with the markets. I don't believe that is the correct mindset to be approaching these corrections with. These corrections usually offer the best buying opportunities of all time, right? When we do have them. So you may as well stick it out, stay in the markets, remove all the emotions from your trading or investing, and just try to find the highest quality companies at the best possible prices, and periodically buy. Your future self in the next 3, 5, 10 years is going to thank you a lot, guys. Percentage of stocks down below their 200-day moving average, a low read of 35. Can this drop more? Of course it can drop more, but is it a good time to start buying into the indexes or even individual names? Absolutely, I truly do think so. So that is your breadth analysis, your fear analysis as well. We are coming into some form of bullish seasonality. April into May and into the early portions of the summer are traditionally supposed to be very decent for the markets, but we know that right now we're balancing seasonality with headline risk around those tariffs as well. If you ask me my humble opinion, guys, for the April 2nd tariff day, 50-50, truly. There's an argument to be saying that we may have already priced in a lot of the fear because the market is forward looking. They're pricing in the absolute worst case scenarios for that April 2nd tariff deadline. If the tariffs are less worse than people are expecting, can we possibly rally? Absolutely. If the tariffs are worse than everybody is expecting, can we see another leg to the downside? Absolutely. We just don't know, which is why I completely understand if you want to stay on the sidelines a little bit and wait for the event to happen, completely understandable. I am also doing the exact same thing. I'm holding my buying power, holding most of my cash in reserves for after that deadline when we get a little bit more policy clarity, not only on that date, but also in the following 2 weeks, because we know that there will be responses from all the countries that are targeted. So the next 2 weeks, guys, be very careful on your trading. And also, if you want to hold back some cash for your long-term portfolios and just wait for the clouds and the storm to blow over the next 2 weeks so that you can get more clarity as well. That is also a very logical and perfectly understandable thing to do, as long as you retain the mindset that you should be buying these corrections for your long-term portfolios overall. So moving into the technical analysis now at this point. So the SPY, taking a look at the SPY, guys, we knew that essentially, right, we were in a daily uptrend, and I was saying be wary of this resistance overhead, because in the event that the bears engulf the move too much, you're going to be looking very closely at a weekly rollover and continuation of the weekly downtrend. The SPY has been in a weekly downtrend now for roughly the past 4, 5, 6 weeks in a row, and with such a very weak bounce on the weekly timeframes, this was only a 38-40% bounce. That is not a very good bounce. It leads us to believe that the bears have more than enough chances this week, especially with all the negative possible headlines that could come out this week, both economically for any one of these reports, or in terms of the tariff headlines. We know that the likelihood of a rollover is very high. If we crack this level to the downside, 550, your next stop, unfortunately, is all the way down here, 530 to 510. That would be a top to bottom correction on the SPY of 12 to 15%. In the event we find ourselves in the next 2 weeks at these lower levels, guys, I really want you guys to have a shopping list built already. And regardless of the fear and the narratives that are being thrown at you, it has always been a great buying opportunity to buy the S&P 500 or its individual components when itself is down 15% off of the local highs. So keep that in mind. The monthly timeframes will close soon. We'll cover these after the April or on the April 1st date when these candle closes. But you can see, right, we are already looking into the signs of monthly consolidation. That should have been clear as soon as we lost the weekly timeframes. Monthly consolidation was underway. We may have one further leg down here. You can see the monthly MACD cross is not looking too good right now for momentum to the downside. So pay special attention, guys, to this level down here. 530, 520 is your next stop. On the Qs overall, we are also in a similar condition. Daily uptrend has now been lost. We have now flushed the lows, so any move up going to be looking for a lower high and then maybe a continuation to the downside for the bears overall. The Qs also on the weekly timeframes, I'll remind you the bounce size was very weak, a 38.2 bounce right directly into resistance. And now if we do have that rollover this week, where are we heading? All the way down here, guys. 450 to 430 is your next area of support. That would be a top to bottom decline, guys, of 16 to almost 20%. 20% is official bear market, which is why in the context of history, it has always been a fantastic opportunity to be nibbling a bit in these low areas. But down here, that is when we need to start increasing the size of our nibbles. I'm not saying blow all your cash. This year, you should be having about 15 to 20% cash in reserve and just be very, very picky on the stocks and the levels that you want to buy. As I said before, you can use my levels, you can use your own levels. I'm not going to tell you specifically when to spend all your cash. All that I need you guys to do is identify the best companies for you specifically, high quality companies, and continuously spend your cash into these markets, guys. It has always been a fantastic opportunity to be buying these corrections. Just think of the next 3 to 5 years if you have a long-term portfolio. And if you are trading these markets, yes, all of these lower high attempts are indeed for short attempts to the bottom end of the ranges. And if you're looking to sell options, as I would be in this market especially, you're really looking for these big red days into next week as well. If you get some phenomenal sell-offs with the VIX at highs, it'll provide you some fantastic put credit premium at the lower ranges, whether you're looking at ETFs or individual stocks. And we'll get into that, of course. Moving on to XLF. XLF also rejecting right now. So we knew that XLF had a very nice daily bounce overall. However, now we are coming out of resistance as we called. 51.37 down to about 50.5 was that area. And now if we do choose to test the lower bound of this range, the bulls have a lot of space to try for a daily higher low and try to go for the daily uptrend conversion. However, the weekly bears have always, had a good chance of shutting them down, right? Which is currently what you're seeing. It was a very adequate bounce, a 618 or almost a 65% retracement. Could we just get trapped in sideways action consolidation on financials? Absolutely. Support area down below, 48.22 down to 46. This is where I would look to go shopping for individual financial names, some of the banks, some of the credit card players, and everything in between. Onto XLV Healthcare. Well, healthcare known as one of the more defensive sectors, but we're battling, right? Battling right now with overhead resistance. We know that the bears were in control right there. We tried to get the daily push, tried desperately to get that daily trend change underway. Couldn't get it done. Resistance very strong, 149 down to about 146.5. And now we get the rollover. I was saying that this on a weekly time frame was indeed an opportunity for a short. It was a weekly uptrend into backtest of resistance. Now maybe looking to get the absolute flush down there, and that would be 140 down to 128. I know it's a very wide range of support, but keep in mind, guys, it's the highs, right? All the highs from 2021 through 2023 overall. Could be an interesting level of retest if you're looking to go shopping for some healthcare companies. Be patient on every single trade, guys. Keep an eye on the weekly timeframes. Taking a look right now at some people's favorite sector, which is going to be semiconductors. So semiconductors really have not done anything, guys, since June or July. We've constantly been stuck. And I was telling you guys as well, right? The daily uptrend was very nice. The attempt right here could not get any higher than 233, which is the top end of our support range. However, we were testing it from below, right? That is always somewhat dangerous because now you knew that the weekly bears were in full control. And I was telling you the bounce size on the weekly was fairly weak indeed, only a 38% bounce, similar to the SPY and the QQQs. And now you're getting the weekly possible downtrend rollover. The next stop for this market is going to be around the $200 psychological level. The way that I'm playing this one, guys, is not with SMH. It's not with SOXL. I'm targeting individual companies into very large areas of support, looking to write some options under the market to accumulate some of my positions. We'll take a look at that when we cover the big tech list a little bit later on in the video. But SMH definitely not having the best week at all. You know, from the Monday session, huge drop here, 9%. Moving on to the Russell right now, also a sector that I was telling people to be very careful about, right? Why? Well, we had a nice daily uptrend, but into where? Into resistance. Same as the SPY, same as the QQQs. And you can see who's been in control of this chart the entire times. It is the weekly bears, right? That being said, the size of the bounce was somewhat weak as well, 38.2%. You guys are seeing a common theme, right? Looking maybe now for a retest of the lows or even lower into the 200 weekly EMA, which is roughly 199, 200 down to about 192. This is the last line of defense, guys, before we really have to start getting into the lower, sub 190 into the 180 range. Not going to call it just yet. A lot of trading left, but definitely not looking too good. The Russell is really not the sector that I want to be playing right now. I think there's some much better opportunities on companies with much better balance sheets. I would not be a big fan of playing, the Russell small caps right now. The Dow Jones down about 1.69%. Also struggling, right? We did not quite breach above our area of resistance right there. It was a nice uptrend, but I was telling you guys, 42.5 to 41.9. If we cannot clear this range, do not expect the bulls to be able to use it as support, right? Didn't get above it that much. That being said, we have now almost fully engulfed the last leg of the daily uptrend, and any back test right now will be resistance into possibly a downtrending cycle. That is if we don't engulf right away on the Monday session. Support stays put 41.3 down to about 40,500 overall. And who was in control of this chart? Well, unfortunately, guys, it was always the bears, right? Always the bears. Barely a same as the SPY, same as the Qs. 50%, 38.2% retracement, not the best retracement size. So now we may be looking to embark on this next leg of weekly selling to the downside. We'll take this one day at a time. The Dow Jones, usually one of the more resilient sectors, but still just getting dragged down with overall market sentiment. Now, moving into some of the minor sectors, consumer defensives. Consumer defensives was very good. So you'll notice something that I was kind of saying, watch the rotation and buy low, sell high. When we were buying the QQQ names, offloaded a bunch of swing trades into resistance. What was being kept low at that time? Well, consumer staples, the value trade, right? We don't want to buy value all the way up here, just as we don't want to buy QQQs all the way up there. You want to switch and pivot when the market rotation provides you the opportunity to do so. So down here was a very good buying opportunity. Now looking like a very nice daily engulfing move by the bulls, looking for a higher low for possible trend continuation. It's looking quite strong for some of the value and defensive names in staples right now. Weekly uptrend. Higher lows, possibly going for the higher highs, looks quite good. If we did accumulate some positions right down there, I don't see any reason to sell them. And even if we have some late positioning here, not the worst trade in the book if you're just looking to play the XLP overall. Into utilities as well. We were calling utilities as well on this retest down below of the 76 region as a very decent swing trade opportunity. It is currently still a downtrend, but a very nice, 60-70% retracement on this. If you get a higher low, might be a good opportunity, guys, if you're looking for some defensive positionings all the way in around here, right? $76, $75. huge area of support, guys. The bulls have been working very hard to defend this one over the past 5-6 months worth of trade. This one could continue to outperform if the volatility and the uncertainty continues to be front and center for the next 30 to 60 days. So there could be a nice positioning rotation here in the event that you are a fan of utilities and wanted to add a bit of a defensive sector to the portfolio. Moving on to real estate right now, real estate really doing a whole lot of nothing, right? It is, however, in a very decent area of support. It's been a nice area the bulls have been trying to defend, at least for same as utilities, right? The past 5-6 months overall, not looking too bad. Monthly higher lows are set. Possibly looking for some expansion. If you're a fan of real estate, this one pays a decent little dividend too. If we're looking to build a position, 41 down to about 39, not that bad of an area if you wanted to add a real estate component. Real estate is a bit of a toss-up, right? We know that real estate in bear markets does not perform too well. It's not my first trade to go for, all things considered. If you are approaching, some form of an economic downturn, real estate tends to get dragged down in the mix as well. So out of all of these, I would be a bigger fan of XLP and XLU, and real estate, special shout out, but it can be somewhat volatile, so keep that in mind. And lastly, energy. Energy, we were calling this one out as a very decent trading opportunity the last few weeks. Why? Not because of the chart. Chart was reason number one, accumulation zone at the highs of the range, not breaking them, looking for monthly uptrend expansion. But the secret was really in terms of that seasonality, right? Here is your seasonality for oil. This is either, when you look at it on a 28-year seasonal pattern, 15 or even 5. Everything points to oil being very favorable from the early stages of spring, February and March, into the July and August period. More people traveling, more agriculture in the Northern Hemisphere as well, and just an overall boost in demand for oil, just transportation on the rise, agriculture on the rise, travel on the rise, makes perfect sense, right? So some of these names have really been lifting off recently. Look at XOM, right? We were calling this one a few weeks ago as well. ExxonMobil, decent little pop. CVX as well, decent little pop off the lows, looking to expand. And even a name like ConocoPhillips, which is slightly lagging behind right now, still at a very great range of support. So this energy trade, especially if you're of the opinion that inflation could come back, and couple that with seasonality, right? In terms of oil, energy, not that bad of a sector pick. I'll remind you, everybody's favorite dividend ETF, SCHD, did do a heavy pivot into energy with their yearly restructuring that happened just last week overall. So energy, probably if I had to pick 3 favorite sectors for kind of this rotation, if you want to be away from growth or hedge the portfolio, defensives, utilities, and energy. Not that bad of an idea overall. Taking a look at the VIX right now, the VIX spiking 16% on the Friday session. And, I like to combine things. I'm a big fan of confluence, and I think you know that by now. When we start having, right, percentage of stocks, the breadth come down into lows, either 20, 50, 200, and you get the VIX pulling up into my favorite levels, 25 to 30. That is when it's a great area of confluence to possibly buy in the markets, especially at extreme fear reads. I'm not saying YOLO and call the bottom. I'm just saying if you're looking for progressive buying opportunities throughout this entire market correction, you should be looking for these 3 factors to line up. It will give you the best chance of targeting some local oversold daily bottoms. So keep that in mind. If the VIX keeps expanding into the week, we'll be looking for expansion into the 25 to 30 region, which is usually synonymous with some form of a local bottom trying to be formed. Peak uncertainty, peak volatility, right? That is when you really want to go shopping, which is why the support resistance boxes are inversed. When the VIX is high, the box is green because you want to buy. When the VIX is low, this is when you know you want to sell. So keep that in mind, guys, in terms of your positioning and your position sizes overall. Taking a look at the bonds right now, 10-year yields have plummeted on the Friday session. This is part of the rotation into the fear and defensive trades, right? So the TLT is a very complex trade. The yields is a very complex trade. But one thing's for sure, when uncertainty starts to peak, you could be looking at a bit of a rollover here for a number of reasons, right? If the economy starts dwindling, the Federal Reserve has ample room to cut rates or cut rates more aggressively, but also you'll have a bunch of people rotating into bonds as a safe haven trade overall. So the 10 and 20-year yields looking good, possibly for that weekly downtrend rollover, which is leading the TLT to uptick a little bit on the Friday session, looking for the inverse, looking for the TLT expansion. I've been telling you guys, Be patient with this one. Bonds are a very complex trade, but I'm fairly confident that over the next 6, 12, 18 months with the rate cutting cycle, possible positioning of growth into safety, the bonds could be a very interesting trade also to add to the portfolio if you are a fan of holding some bonds. And lastly, moving into gold, well, gold, absolute monster of a trade recently, guys. You know, we were looking for the higher lows and they came into us, right? Came into the 12 EMA, which was the first target, barely tapped it, and then moving on. I would say that gold positioning right now, let's be honest, guys, you are late. I will never dissuade anyone from buying gold if you have a long-term perspective, right? But if you have a swing trading perspective, you have to be very, very cautious on where you are buying gold, and possible, especially if there's sizable swing trades, trade with a stop loss, and the stop loss always comes below the recent lows because you don't want to get caught in extended daily consolidation on gold and just be picking the tops right here. If we've accumulated some positions this entire time, I see no reason to sell. If it's part of a long-term portfolio, I see no reason to sell. Gold over the long term, although it's not a productive asset, provides a great hedge to any portfolios if you're running some sort of a barbell strategy, right? 40, 50, 60, 70% equities, some bonds, and some gold on the side of that barbell. Not that bad at all. Gold is looking very good for technical expansion, but just be cautious, right? Every time we come into some form of daily overbought conditions, as we're seeing right now, daily overbought conditions, weekly overbought conditions as well, you know that you're probably late to the trade if you are looking to size trade gold. I'm not saying it can't run further, but just know the risk to reward is not in your favor right now. You'd rather be in tune with waiting for some weekly higher lows, and gold always provides them. It always gives you a possibility for some weekly higher lows, right? So you may as well be patient with it and not just continuously chase the market as you panic sell out of your equities and full port gold right now, right? That's it pretty much for your sector and some commodity analysis and the bonds. Now let's move into some big tech names, because we know big tech is front and center on everybody's minds, right? Is the big tech trade over? Is the US excellent in their tech services? Over? Have they spent too much on data centers? Well, let's have a look, shall we? So in terms of Apple right now, we knew that Apple was somewhat challenging. It was a nice daily uptrend. We're looking for a higher low, anything above 211, looking for a higher low for possible trend continuation. However, if the markets continue on what happened last Thursday and the SPY, right? The SPY lost the daily uptrend. The Qs lost the daily uptrend. Well, Apple may just be very soon to follow. Just use the indexes as guides. Who's in control of the weekly time frame? I'm glad you asked. It is, of course, the bears. And with the weekly lower highs, possibly not, you can't call it just yet. You need a loss of the daily uptrend to really confirm these weekly lower highs are set. But let's just say they are. What is the size of this bounce, guys? Only 38.2%. So that gives the bears ample opportunity to either retest these lows or flush even lower. If they do flush even lower, first line 210, and then the next line is 200 down to 190. This is the area that I'll be looking to play Apple more aggressively. I think that would be a decent top to bottom sell-off of 22 to 26%. Which is usually a great time to be playing Apple, all things considered. Not even close to daily oversold conditions. I love to see a weekly move come down into a big level with daily oversold conditions. So that is what I'll be patiently waiting for on Apple myself. At 220, the valuation is way too high right now, too soft of revenue growth overall for Apple. Fantastic company, but the valuation just is not there. There's tons of other cheaper stocks in the market that have much higher revenue and EPS growth rates. Moving on to AMD right now. AMD, unfortunately, sacrificing a lot of its gains last week, right? Moving on here, top to bottom, 11% in just 3 days. Now, that being said, we did have a very nice, daily uptrend on AMD right now. The higher lows are being challenged, almost losing the last leg of the daily upswing right now. In the event that this daily uptrend is lost and we set a daily downtrend, the bulls on the weekly did not do that terrible of a job, right? It was a nice 100% engulfing move. It gives them a chance of setting higher lows into higher highs. But if the overall markets don't cooperate, guys, the SPY and the QQQ, do you think AMD is just magically going to pull a rabbit out of its hat and set the weekly uptrends? Probably not. Targets to the downside remain $98 to $97. To the downside, if ever the weekly bears are too strong and roll over. I'll remind you, the valuation of AMD right now is very, very, very cheap, but this is a longer term play. The next roughly 12 to 24 months for AMD, that is when you really start seeing them come into their favorable fundamental thesis right now, which is going to be very nice expansion of EPS and very nice expansion of revenues. I will be patient, very patient on AMD, guys. my next target location for selling puts under the market or accumulating shares for a portfolio in which I'm looking to make a 12 to 24 month swing trade at this point, guys, has to be like the lower 90s down at 80 bucks. I'll be very patient with my AMD buys, especially in this market. Moving on to Amazon right now. Amazon down 4.29% overall, not the best day. Also sacrificing, right, the daily uptrend that they had. Retest of the lows, getting all of that move back and now testing support 191 down to 183.60. Now, since we have arguably lost the daily uptrend, now take a look at the size of this weekly bounce, yeah? How good was the size of that weekly bounce? 25%, not good enough. We know the weekly bears are in control. They gave back the weekly uptrends, the bulls did, and now we might just be looking for lower high into lower low. At this stage in time, Amazon is already off its highs by 21%. I will once again be looking for confluence. I need to see daily oversold conditions, and if we get another leg of weekly downside, I'll be looking for the big one. The big one for me on Amazon, guys, the really big level for some bigger trades is 175 down to 150. I know it's a big range, but that's because it's the whole range from 2020 and 2021. Amazon sitting at a very, very attractive valuation right now, 1.5. We do not know if it's going to come down here. I have been nibbling some Amazon shares for the long-term portfolios, but if you want to know, this area for me is a nibble. This area for me is a sizable nibble, all things considered. If it comes down there for some reason, that will be a sell-off of 28 to 35% off their all-time highs. Go back in history, guys. When Amazon is off its highs by 30+%, right? Even if you clip it down here, is it a good buying proposition to start loading up some shares? Yes, just go back in time through all the corrections, guys. 30+%, even 20%. Are they good buying opportunities? This is 2014 as well. 20, 30%. Is it a good location to be buying Amazon when Amazon is improving its fundamentals every single year? Absolutely. And you go back in time as well. If we retest 2021 prices, look at the fundamentals. Is Amazon better or worse than 2021? Well, here's the EPS. Look at the EPS next year, almost a 2x. Look at the revenue, 2021, 470 billion. Look at the revenue this year, 700 billion. That's over 50% better. And you're getting it maybe for the exact same stock price. That is what I like to see, getting stocks at exactly the same levels, although they have drastically improved their fundamentals. Moving on to Google right now. Google, same concept. Google getting absolutely destroyed on the Friday session. We know it's been out of favor and it continues to be out of favor. However, if we have a long enough time horizon, I think that all buys here will be heavily rewarded. That being said, who's in control? The daily bears. We're always in control, right? With a nice little bounce size here by the bulls, but never recaptured the daily uptrend. And we were saying if ever they give back too much of the move, the bears are going to be looking pretty for just weekly lower highs into lower lows. Now we've got it. This bounce size was very weak. What Google needs, guys, you need a small leg, right? Because when you get a massive leg down like this, it's very tough to V-shape. And also, if you're looking for a two-stage recovery, it takes a long time. What you need to see is on a second or third leg down, a small leg. You will notice that the legs usually get smaller and smaller and smaller as we drop. Look at this leg right here. This is much more easy to engulf and change the trend than something like this. So I'll be very patient on Google. The next stop right now, since we've broken down below this level right there, I unfortunately have to change this box into red. So red on Google right now, unfortunately. Now becomes resistance, 165 up to about 175 overall. The next big area of support we're looking to is down here, 153 down to 140. Phenomenal opportunity. And look, it's the 2021 highs. So is Google doing better now than it was in 2021? Well, let's have a look, shall we? Let's look at their EPS. EPS 2021 was $5.60. This year, $9. A lot better. In 2021, revenue $257. This year, $389. Both up 50%, and you're getting it for the exact same share price. If Google falls down into that location, which is highly probable now, 26 to 31% sell-off. Has it been a good buying opportunity to start buying Google at 25 to 30% drop-off? Yes. Can it go lower in peak bear markets? Sure, but probably not in a very straight line, right? Take a look at all the sell-offs on Google. Use historical data, guys. 20, 21, this one here, this is 2018, by the way, 17. Whenever you're looking for sell-offs, and I can use the Class A shares, which gives us a lot more data, right? Even all the way back here, guys, is it good buying opportunities to buy Google 25, 30% off the all-time highs when they're improving fundamentals? Absolutely. And look at the valuation right now on Google, yeah? you want to find something cheap, right? I think Google right now has largely de-risked everything at this point in time. 17.5 on a forward price to earnings basis, 1.16 on a forward peg. So I'm looking for confluence, guys. Large areas of weekly support plus daily oversold conditions plus good valuations. 3 of 3, that means that I should be buying some Google here if it's a company that I like. I'm not trying to impose Google on you. I'm just saying for those of you that do enjoy Google, you may want to consider nibbling more Google at these locations. Not financial advice, of course, only if you are of the same opinion. Moving on to Meta right now. So Meta also down 4.3%. Taking a look at the technical analysis too on Meta, right? Full engulfing move of that daily rally. We knew that Meta was in a very large sweeping daily downtrend and nothing has changed. Big engulfing move wasn't enough. Just gave it all back and lower, now below the 200-day EMA overall. And that weekly, unfortunately, now that we have re-lost any daily uptrend attempt, now the weekly lower highs are set. And you might just be looking at leg number 2. The support area stops at 560. If you breach that, look out one level below. You're coming all the way back down here to roughly 523. Sorry, I need to modify this box a little bit and just grab all the data. The next big box, guys, 530 down to 450. I know it's a very wide range. Of course, it's a very wide range, but that is the monthly level of accumulation that these bulls were in for about 6 months of time back here. That's why I say we want to be getting as deep as possible into here. Meta can have a little bit more to sell off. They're currently down 21%. Is it a good buying opportunity to be buying them when they're 25 to 30? I think so, because Meta right now is a bit expensive. So I'm staying patient on this one. Meta, although the forward price to earnings is good at 25, their earnings ratio growth rate is not that high, which leaves them still at a forward peg of 1.9. So out of all the big tech names, this one is a little on the expensive side. So if I am going to go shopping for it, I need to find it a bit lower. If you're asking me where, I mean, I'm nibbling here, but where would I go a little bit heavier, guys? You know, 500 and below. I would gladly appreciate if Meta comes down there and picks me up. Moving on to Microsoft right now. Microsoft as well. Big day of sell-off, 3% day. You do not see those often on Microsoft and only on sentiment-driven days, right? Into resistance. We were warning about this. Daily uptrend was nice. Into resistance though, 395 up to 408 was the resistance range, and perfect back test for the bears. Keep in mind, right? Weekly downtrend, nice move up. How much was the size of the bounce? I was telling you guys, watch out. It's only at that stage a 38.2% bounce. If you were to roll over and flush these lows and go into more weeklies, the downside potential is very likely for Microsoft. Now we're into support 378 to 365. Is Microsoft a good buying opportunity down here? I do believe so right now. At 380 roughly, it's a 2 peg. It's a forward price to earnings of roughly 29. That's relatively fair, all things considered, for Microsoft, guys. Can we dip a bit lower? Yes, but this is a great backbone to any growth portfolio. Very high margins. Microsoft is such a strong company, arguably one of the strongest in all of tech, not let alone big tech, right? Continuously expanding EPS, continuously expanding revenue as well. Notice how all these companies, guys, I'm not giving my speculative thought process on what could potentially happening. I'm focusing on the valuations, only valuations and the technicals. I want to find confluence, right? Big weekly down move into support. Give me daily oversold conditions as well and a high VIX, and I will gladly buy some shares down here. I'm not saying it's the bottom. I'm just saying we're trying to time our bottom picking entries for DCA purposes when we find areas of confluence. The last time I did it was down here, didn't do anything up here. And now if we drop lower, I'll do it again down there with confluence. Moving on to Netflix right now. So Netflix as well, forfeiting a bit of their gains, have not lost the daily uptrend yet, right? The daily lower highs, or sorry, higher lows are right here, 918. But we did break through this area, all the moving averages too, coming into support, 936 down to 900 on Netflix. But keep in mind, I was telling you guys, when you have such a large retracement size on a weekly move, this retracement right here from this bull move, right, is a 78% retracement. The likely scenario is not V-shaped to all-time highs. The likely scenario at best for the bulls is a 2-stage recovery process. At worst, it's a lower high for the bears and rollover. So pay special attention to how we react from this level. If we just blast through it, it's not going to look good, and you will be looking for possible weekly downtrend to join its sector and industry peers into monthly consolidation. Netflix needs it. It has not had monthly consolidation for a very long time. If you ask me, where could we go, right? If the next 30 days are really bad, we can easily go back to the $800 range. that would not be too crazy. If you look at the 3-month time frame, this desperately needs consolidation as well. So if I'm looking to buy Netflix, it has to be a DCA approach. We'll be targeting the lows, try to go as well when you see daily oversold conditions and big weekly levels of support. That is when you should maybe nibble a little bit of Netflix shares. But if you want my absolute god tier entry, I'm not saying we're going to get it, guys. Put a line down here at 700. And if it does come down there at any point this year, this is an area where I would go heavy on Netflix overall. The valuation right now at 950 is not bad, not bad. But if you want to see Netflix cheap, and I'm talking cheap, it has to come down here. I'm not saying it's going to go down there. I'm just saying if it does go down there, that is where I would go heavy on this fantastic company. Moving into NVIDIA right now. NVIDIA also losing the daily uptrend, daily downtrend right now into the lows, into support, which is 111.50 down to 102 overall. So daily downtrend lost. You know that means that the weekly lower highs are set. And I was telling you guys, be very careful. We're not able to breach the 200-day EMA. And even if we do, we have resistance above us, right? 125 to 135. Not the best idea to be going long NVIDIA here when they've had how much of a rally off the bottoms? A 17% rally off the bottoms into resistance, and you're only looking for a weekly lower high. Not the best proposition, right? The best proposition is waiting for confluence. Weekly big levels of support, which is the end of the 101, 100 psychological, right? Weekly downtrend. If the bears are going to push, they're going to push down into that level. If you come down there and give me daily oversold, which would be a few more big red candles like this, give me daily oversold. Perfect. I'll maybe buy, well, I'm not going to buy shares. I'm going to use short puts. Yeah. Short puts down here, guys, 95 down to about 80 bucks. Very juicy for NVIDIA. NVIDIA right now under 115 is sitting about a 1.1 peg. Forward price to earnings of 25, even a bit lower now that they're at 109. Looking pretty good, but the weekly bears are in full control here. Don't get too greedy saying this is the NVIDIA bottom, we're only going up. No, no, no. We know there's a lot of concerns over will they be able to maintain their pricing power as new competitors enter the markets? Are big tech companies with the economic uncertainty, are they going to scale back on their data center operations? Microsoft has already canceled some data centers in Europe and America as well. Will that continue? Will other big tech players follow? And will NVIDIA orders dwindle over the next year? Keep in mind, NVIDIA is curling right now. Revenue expansion, EPS expansion, curling over the next 2 years. Revenue curling over the next 2 years. That's why people and institutions are no longer buying this stock hand over fist, the same as they were during the expansion cycle where there was no cap to their growth. Now their growth in EPS is curling over. So if you want to buy this company, you have to be very greedy and buy it at fear levels, which means high VIX, daily oversold, be patient, wait for your entries, yeah? Moving on to Tesla right now. Tesla down 3.51%. Another stock that I was telling people, don't be too greedy up here. We are coming into resistance 300 down to 260, yeah? Daily uptrend was nice, but I was telling you guys, where are we moving into? A very steep level of overhead resistance. It's been acting that way for several times in the past, and this weekly downtrend was very, very, very strong, guys. At this point in time, the daily uptrend seems to be challenged right now, looking possibly for continuation to the downside if the lower highs are now set and that was the top of the move. Very weak bounce by Tesla, 30% bounce. What does that tell you? The likelihood of revisiting the lows or lower is very likely. The next destination of support down here, 220 down to 191. And in terms of valuation, guys, even here at 263, I did it at 235, which is better. Are they cheap right now? No. And they have deliveries coming up on April 1st for the past quarter, and they have their earnings April 29th. I will not be playing Tesla before I see those deliveries, and probably not much before earnings as well, because I do not think they had a very good quarter. Moving on to Palantir right now. So Palantir down 4.71% on the Friday session. Now Palantir as well is one company that trades relatively expensive. So you know that when growth is being pulled out of the market, this one will get hit bad on big red days. But, you know, Palantir, you would have expected otherwise. Palantir to be down 8, 10%, only down 4, not too bad. Daily uptrend is still being maintained. Barely, the higher lows are here, 81.59 into support 84, down to about 77. If you lose this level and engulf this move and set up the daily downtrend over this next week, guys, that is your weekly lower high. And I'll remind you, the size of the bounce as well was not that great, only about a 40% bounce on Palantir after such a big sweeping engulfing move. The expectation is not new all-time highs. At best, it's a two-stage recovery process for the bulls. At worst, that is your lower high and going into weekly downtrending cycles for Palantir, which means monthly consolidation. And Palantir desperately needs some form of monthly consolidation. Way too overbought on the monthlies, guys. It happens to everybody, even Walmart. Walmart chart looked like Palantir, now into monthly consolidation. It only takes one piece of bad news, and that'll be it to consolidate Palantir even further. The next stop, if that does happen, 72 down to 64. I'll be a big fan of playing Palantir if I can get some strikes under $60. That is just my opinion. Moving on to SOFI right now. SOFI down about 2.87%, being unwound after the Robinhood news. Of course, we covered that on the Wednesday session. Now, daily uptrend was nice. Sacrificed all of it, coming down below the lower lows, 1182. The bears have fully engulfed this move. Normal, I was telling you guys, don't be buying SOFI up here, right? $14 to $16 is directly into resistance. Who was in control? The weekly bears were always in control. We knew there was going to be some form of a reaction right there, and any negative news, the bears would just run with it and take advantage, which they did. Keep in mind, on SOFI, this was only a 50% bounce. Decent, but not a 618 or 718, which gives the bulls a great ability to recapture the uptrend. At this point, we'll be looking for the lows, 1090. But I love SOFI in this location, guys. You know, 1170 down to 950. You want to get as low as possible. My favorite way of DCing into SOFI, short puts under the market, 11, 10, 950, fantastic. But once again, I'll be looking for confluence, weekly support levels, right? Daily, as close as possible to oversold conditions. And then we can get a far, far, far better entry and know that we have put the most amount of odds in our favor of possibly picking some of the local bottoms. It was the same case here, yeah? Daily oversold into huge weekly support. You know that you have a very decent chance of an entry position. Moving on to Uber right now. Uber also coming down 2.82%. Not the worst day for Uber, but still somewhat being unwound. The higher lows are still set, 70.57. Coming into support, 73.34, down to 69.30. On the weeklies, we have not lost it. However, be mindful, 69.35. You lose that, you lose the weekly uptrends. And unfortunately, we're heading right back down into the $60 range. I would love to find Uber as cheap as possible. Right now at 70 bucks, it's a one peg with a fantastic free cash flow yield. I'll be very patient on this one. You may see some short puts on my account. Short puts meaning I want to buy the stock under the market. You know, if I can find like some 65, 60s with a high VIX in the next upcoming weeks, I'll be a very big fan of targeting Uber's lower range. A little bit too much uncertainty for me to rely on this short-term support section right now, but a fantastic company overall. Nothing to say, right? Profitable right now. Look at their EPS expansion, doing very nicely the next 4 years, and revenue expansion doing very nicely as well. And lastly, TSM, even though TSM's a high-quality company, extremely high-quality company, guys. I mean, they have 40% margins for a product company. They also have some of the best expansion in terms of EPS year over year, and also revenue year over year expansion is beautiful right now. They're trading very, very, very cheap on a forward basis, right? A 18.6 on a forward PE and a 1.09 peg at a 3.6% free cash flow yield. Decent valuation for TSM, guys, but the technicals showed who was in control the whole time. I was telling you guys, this is a very weak bounce for TSM. 2 weeks and they can barely get up a few percentage points into resistance, kind of like NVIDIA, not the best, and they got rejected right there. And now the absolute rollover. Bears are back in control, and he moved higher looking for a lower high into lower low. Good thing we're into support right now. 170 down to 158. If you somehow flush this zone, guys, be very careful because the next big area comes down here at about the 144. So at TSM, even though TSM's a high quality company, nobody is immune in this market right now. And that's why it lines up as well with my 145 area with the 26 EMA. That is probably going to be the next area. You know, did I buy some TSM shares here? Yes, but super small. You guys saw it, right? My next big buy area, always going to be significantly lower, guys, starting at like the 145. Ideally, you want to be getting as close as possible. I'm not saying it's going down there. I'm just saying, where do I go heavy? You know, I'll nibble throughout the way. Where do I go heavy on TSM? The next place you guys see me go heavy is all the way down there, which would be a top to bottom drop. It would be substantial, right? 30, 40%. Anything's possible. I'm just giving you guys heavy levels. And all of these heavy levels, keep in mind, is if we maintain these weekly downtrends on the indexes. We'll take this one day at a time, but I'm just giving you guys, you know, nibble areas and also the large areas where I'm going to be going heavy on these positions overall. That is your weekly recap for all the sector analysis. and all the big tech names. I'll be doing a lot of swing trade coverage on the Sunday video when we go through the top 5 options plays, but that is pretty much it for that list. Now, let's dive into the portfolio, shall we? So taking a look at the portfolio here, you will see that really not much has changed, guys, since the last time we spoke on the Monday session when I gave you all these positions overall. If anything, our covered calls that we did on the Monday and Tuesday sessions have been paying off fairly well. We've had these AMD call options for a very long time now. Since December, we did the 135 covered calls for May. We got about $1.85 in premium, and they've been working well just to reduce some of the blow of the market sell-off that we've been having. I'll continue to run covered calls, poor man covered calls, on my leap call positions. Not willing to close these just yet. So overall, just reducing our cost basis. We still have the very tiny swing shares, like the Amazon swing shares that I bought a few weeks ago at this point. Saw the underwater AMZU as well, covered up with a $36 covered call. Our average cost basis on those, if you guys want to see overall, just do a quick, very quick recap. Yeah, assignment tracker. If I go all the way down there, I always keep track of my break-even costs on all my assignments. I want to take a look at the AMZU one. AMZU is right here. Our average cost basis right now is $36.41. So although we are below that, we've collected some good premium on these May covered calls so far, and they are now profitable. We'll just be trailing this one to the downside through off the sell-off. Very small position overall. The ARKGs, these were like lottery asymmetric bet leap trade contracts for 2026 and 2027. Very small. I'll keep those, see what happens. AXP, small swing shares that I bought a few weeks ago, they're still here. I've been accumulating some swing shares, guys, in this market and staying away from any short-term call options or call debit spreads. Most of all the call debit spreads I showed you guys were closed last week, and now we're just a bunch of shares. The wheel strategy and shares, pretty much. Elf Beauty, we remain in Elf Beauty right now. Our Elf Beauty position, we collected a bunch of covered call premium on the Elves. You look at my cost basis now on Elf, $59.91. So we're in profit right now. I'll continuously run covered calls on this ELF position and reduce my average cost. Very happy with my average cost on ELF right now. Ethereum is kind of a throwaway right now, 200 shares, very small position overall, 2 times leverage on ETH, but very tiny. FICO as well, we still have those swing trade shares, nothing's changed there. The Google, this was a Google leap call position. You can see it's down 64%, but it's not actually, it was a call debit spread that I broke down. If you see it right here, the call debit spread leap, the break even is 36.16 because we closed the short side of the call with a profit. So now we're riding Google, still a lot of time on that contract, but obviously guys, on a day like Friday, this one came down a bunch, right? Now we also have the Google right here. We got, excuse me, these are covered calls, right? For this Google assignment position right there. The Google covered call position is not doing too poorly overall. I don't know why. I don't know why there's 2 positions for Google here. There should just be 1, but I digress. All things can, oh, this is a call debit spread. Sorry, they're not putting it together. It's a call debit spread. It's roughly down about 40%. Let me see if I can refresh that for you. There we go. Now it's shown up properly. So the Google bull call debit spread for June, 180, 185. We'll see it's currently down a lot right now, but very small position overall, right? Here's the Google shares that I got assigned, the 185s. We did a good job of writing some covered calls on that position on the way down, but of course we're down on the position, yeah? So if you want to see the Google average cost basis, it's all the way up here. Here's the Google assigned price and the cost basis, 174.26 with the new recent batch of covered calls that we got for $4.80 on the Monday session. We locked in a bunch of premium. I'll just be trailing it to the downside and reducing my cost basis. I do not want to get rid of these Google shares. If anything, I just want to perpetually reduce my cost basis with some covered calls, and then we will take it from there. Grab also a very small position. We have some covered calls on those. Intel, you might remember I had 3 of these contracts. We wound down 2 of them and very handsome profits after the CEO news. And now we're basically holding 1 for free with an expiry of December of 2026. ISRG, more share swing trades. KWeb, another leap position that I had. We had 5 contracts. I've wound down 3 of them for very handsome profits. You guys saw those. I'll hold these 2 ones and maybe even add more if KWeb comes back down to 32. Lockheed Martin, our newest swing trade position for shares. Great company, great level as well. That 440 down to 420, decent support if you want to see it. It was one that I've been talking to you guys about for the last 2 weeks, right? Very good level, guys. Horizontal support, very nice uptrend right there. 200 weekly moving average. Fantastic area for a fantastic company. Then further, Moody's Corporation, haven't touched these in weeks. Meta also, we got those a few weeks ago at the lows. daily oversold. Now my next DCA on Meta, you guys know where it's going to be, right? Lower 500. So we'll just build these swing trade positions. MSCI, same thing. We're going to build a little bit more on that one. MSFUs, no secret there. We rolled these about a week ago at this point, guys. None of these should be new positions for you, but you can see our cost basis on MSFU right now. Well, it's going to be the same because we just rolled the put. So it's basically 33 minus $3 in credit. Gives us an entry of 30 right now. Microns, these are pretty much almost dead. They were swing trades from last September. Asymmetric bets on call options, very small. Whenever you guys see me play call options for earnings and stuff like that, very small. Nike bull call debit spread, we have 2 of them right now. Not doing too well as Nike keeps hitting lows, but we have until July to see what happens with that position. You notice all of my little swing trades when I use call options or debit spreads, they're very small. The bulk of my account right now is in shares or the wheel strategy. We just got assigned some shares of NVIDIA on the Friday session at 112. NVIDIA, what I'll be doing, guys, is massive covered calls. Wait till the Monday session and you'll see what I'll do. I'll go with in the money defensive covered calls for a ton of premium through May, and which should give us a break even of under 100. I'll show you guys what I do with that on the Monday session. We also had this lottery trade for NVIDIA, the 150 call options. This was given as a lottery trade, and I was really saying, like, you should be ready to lose the entire position. Obviously, it could have gone either way after earnings, but this position was given, if I can find it, pure lotto. Don't do this if you don't want to lose 500, 900 bucks. So just use some of my profits that I had at that time to take a bit of somewhat of a heavy lottery swing trade on NVIDIA. That position is now dead. So it's just going to be a tax loss for this year, I guess. Pepsi, little call debit spread here, performing well. That was a value trade. Restoration Hardware, a newest position, very small, guys, a little feeler position. I'll add to this one into the lower 200s. The valuation of Restoration Hardware, we did some valuation on it. Tremendous valuation on this company right now, 0.46. You may be thinking, yeah, but it's out of favor. It's large consumer discretionary. The prices of their stuff is very high. This is true, but I'm accumulating some shares, which I might be looking to hold over the next 6 to 12 to 18 months, because I think we could be seeing some very decent gains on that one in the long term. So this will maintain a very small position for me for now. SOFI as well. We have those 100 shares from 16. I'll remind you, we've been writing some covered calls on those on that position. The SOFIs overall, if you want to see my assignment cost is, well, the assignment cost was 16. We got the covered calls all the way down to 13.92 cost basis on SOFI. Now is the time to DCA for me. $11 short put for April 11th. We got 18 cents. They're underwater right now. I wouldn't mind buying more shares of SOFI at 11. That's going to bring our cost basis down into the 12s. We also had these swing trades from, or rather lottery trades on SOFI earnings. Those calls are now for the most part dead for September. I'll leave them there, see what happens. If we have to take the loss on those, no problem at all. I was willing to do it as I got into the trade. But guys, you know, these are not leaps, right? They were a play for earnings. It didn't work out. Same as NVIDIA. It is what it is. Usually very small, but now in this market, not doing these anymore, just focusing on shares and the wheel strategy, which is a lot more consistent overall. Same thing here for the SOXL May 16th, 25 call. You guys have been following this one for how long now? Since like October, November. It's been in the account for a while. We did not lose $1,000. In all reality, we played this one with a lot of covered calls in the meantime. The cost basis is now 553. We're probably going to lose the entire position of that. I'm not going to manage it anymore. We're just going to close this one out in the near term future, but no longer any premium value on that one. SPGI, another swing trade position, which is being built. TLT, 2 call options. This last one here, the Junes, I started it back in August. We've been holding them on to a while, and TLT never expanded. I'll keep it, though, as kind of a risk on hedge. And we have the leap call contract, the 80s for 2027 as well. TSM, more swing trade shares that I'm building in terms of position. We're currently down on them, but that's okay. Next DCA comes in the 140s. And lastly, the Square, leap call positions for January 16th. They're currently down right now. As you can see, they're down to like, I don't know, like $1,000 overall in terms of $800. But that's not the full picture. I had 4 of these contracts rather, from all the way back then. If you want to see the profit currently on XYZ is $1,000. That's if literally I were to lose pretty much everything right now. We're still walking away with $1,000 of profit on these contracts. Even if I close everything, this is all the cost from the 4 contracts. I can lose this entire position and not even care. So overall, you can see a lot of unrealized losses right here. Why? Because I've closed a lot of the profits I was looking to take. Some of these unrealized losses are on shares or on wheel trades, which will eventually come back. but some of the call options, you know, the Microns, the NVIDIAs right here, the SOFIs, those are probably not coming back. The SOXLs, we'll wind them down, take the tax losses on that. And overall right now, guys, we're sitting on an absolute ton of buying power leading into next week. So I'll continuously be very patient on all of these positions and look to diversify a bit more into some value names for some wheel strategies. CP is a value wheel that we have running right now. I'll be looking for kind of more of those value wheel trades and just trying to balance with my technology exposure overall. The other portfolio, the small long-term account that I'm starting with you guys, we started off here with a balance of $3,000 2 weeks ago. I was waiting for the extra 2K to come in. Promised you guys I would start off with 5 grand, and we did actually start off with 5 grand right now. Now, all the money has essentially been spent. We bought our last batch in terms of the 2 grand on the Tuesday session. I didn't even wait for longer. I just wanted to get the money into the market. If you look at these small long-term here, these are all the buys. Feel free to pause if you want. These are the averages, the average prices at which we bought them. This is the total cash amount that we spend. And the long-term portfolio that we're building now looks a bit like this. This portfolio will be receiving $300 every 2 weeks, or about $150 per week. I want to replicate what everybody should be doing when looking to start or build a long-term portfolio. The positions for now are very simple overall. In terms of the market value, you can see which ones are weighted higher than others. Amazon, ELF, AXP, AMD, Google, Meta, Netflix, Melly, TSM, and Microsoft. I'll be building this portfolio with you guys on the channel for years to come, guys, right? These are just my first initial holdings, 10 companies concentrated into the companies that I feel will be doing the best over the next 12, 24, 36 months. Some of them are going to be longer duration, like swing trades. Like, I'm not going to keep AMD in my portfolio for the next 10 years. It's good risk to reward right now. It has good velocity for appreciation. I'm looking to take advantage of this one. So this one is probably not going to stay in the portfolio forever, but I want to, when you have a small balance, guys, or a small account that you're making, you want companies with velocity. It serves no purpose to build a portfolio of 30, 25 different stocks here and be fully diversified and have stocks that don't move very fast in there as well. You want to have fast movers when you're starting off small. As the account grows, 15, 20, 25K, 30K, then you broaden out into some more defensive names such as Visa, MasterCard, you know, other companies that I have in my long-term portfolio, which we'll get into, but this is the markup of the portfolio right now. So hopefully that is clear. We'll keep an eye on how this one evolves over time, but not looking terrible right now. Of course, some positions are down, some positions are up, but overall, very happy to have put money into the market at these levels and starting this long-term journey with you guys and just focus on a DCA approach for the long term, high quality companies at good valuations overall. Some of that may be debatable for you. Maybe you don't like ELF. Maybe you don't like AMD. Maybe you don't like other companies here. I like these companies. They're solid. They're high quality. They're good valuations for me right now. And we'll be building into these positions over time. Sure, you can question whether or not I should have waited for some of these companies, but that's not the point, guys. We're not trying to time the market with this overall portfolio. It is a DCA approach over the next few years and years and years. So we'll be taking advantage of some of these dips in this market. That is everything I had for you guys today. A lot more swing trades will be made public in the top 5 options plays that I'll be releasing tomorrow. But that's all I had for you guys today. If you enjoyed that video, consider dropping a like. I would really appreciate it for the growth of the channel. Consider subscribing to the channel if you're new. We do these videos every week, Monday through Friday. We also love to do recaps on the technical analysis and all the news events and the earnings in that season too. And lastly, if you have any questions, guys, always feel free to leave them down below in the comment section. Would love to answer your guys' questions on the current market conditions, on stocks, on options, fundamentals, anything you guys want. Please feel free to leave it down below. That's it for me. I'll see you tomorrow in the top 5 options video for the week. Should be a very interesting one. And you'll notice we're going to go for very cheap and very greedy on our levels. With high VIX, we can get some much better levels under the market. So looking forward to making that video for you guys. Take care. Have a great rest of your weekend. That's it for me, and peace.